What if one simple investment could eventually pay more than your full-time job? I'm talking about investing $50,000 one time into a single ETF. I believe the Goldman Sachs NASDAQ 100 Premium ETF has the potential to multiply your wealth and income faster than any of the competition and is the fastest path to financial independence that I've found. Most people think that investing is about growing the biggest balance possible. Not me. I think investing is about buying back your time. And that's why recently I've been very interested in income producing assets. Instead of constantly asking how much is my portfolio, I ask how much did my portfolio pay me this month? In this video, I would like to introduce you to GPIC's fundamentals and strategies. And then in the second part, go over real world examples of how you would have performed had you bought at inception, as well as project how the fund's projected to do over the next few years. I can't stress the importance of the latter half of this video enough. I think you're going to be pleasantly surprised by exactly how well this fund's projected to perform and how a small investment could eventually cover your paycheck in much less time than you thought possible. With a lot of other ETFs, that timeline sometimes can be up to 30 or 40 years, not with GPIC. So firstly, what is GPIC? It's a Goldman Sachs ETF designed to provide exposure to growth stocks while generating additional income premium through covered call sales. This means that instead of relying specifically on only stock appreciation, they also have regular cash distributions from these covered call premiums. Instead of waiting decades to sell shares, your investments begin paying you along the way while you wait. Imagine every distribution is reinvested into more shares, and then those shares help you buy more shares, which produces even more additional distributions. The income snowball gets large, and that happens fast. I think this, when the snowball's starting to get bigger, is where a lot of people quit way too early. With traditional investments, seeing real results may take 20 or 30 years. But with GPIC, those rewards come way sooner. And as always, with any investment, we want to consider the expense ratio. And I'm pleased to say GPIC is only 0.35, which at first glance may seem like a lot compared to other funds like SCHD or any of the Vanguard ETFs, but we're looking at the covered call space. And in the covered call space, 0.35 is actually significantly less than many of GPIC's peers. And looking at the top 10 holdings, it's everything you would expect in a high-flying NASDAQ ETF. We have NVIDIA, Apple, Micron, Amazon, Microsoft, AMD, Alphabet, Tesla, Meta, everything you would expect. If you believe the future is AI and technology, GPIC's got you covered. Certainly holding more high-flying technology stocks does have its risks, but if the last 10 years have shown us anything, it's that technology might just be here to stay for the long haul. And I understand that some people may have had a sour taste in their mouth with some of the older single stock covered call ETFs, which just seem to have so much NAV erosion and honestly, not much distribution growth. But that's not the case with GPIC. Since inception, it's actually up 47% on a price return basis, which outperforms many ETFs that cover sectors. And on a total return basis, it's up a monster 95% in under 3 years. The combination of price return and distribution reinvestment makes GPIC a compounding machine. Imagine waking up one morning and realizing your portfolio now pays you enough to cover your mortgage. A few years later, it covers your groceries and then utilities. Eventually, it covers everything. That's the beauty of compounding. You might not get rich overnight, and with other funds like VU or SCHD, it may take you 30 or 40 years. But in the next section, I think you're going to be pleasantly surprised at just how efficient GPIC is. So now let's look at a real world example. An example of GPIC in action. As the title suggested, we're going to start with $50,000, a one-time investment. So as some of my long-term viewers may know, I do love looking at the data. So I'm going to start off by assuming we bought at inception on October 24th, 2023. Today, our $50,000 would have grown to $73,630. If we had taken our distributions and used those on paying our bills, buying food, if we'd have just took those distributions and not reinvest, we'd have $73,000. Not too bad, but that's not where the magic happens. If we had reinvested all of our distributions, we can see that the real magic happens and we would actually have $97,495. We would have almost doubled our initial investment in only 2 years and 9 months. It's hard to do that with a normal ETF, let alone a covered call ETF, which may sell some of the upside potential. So if we had put that $50,000 in at inception, our monthly dividend starting out would have been $491. In over 2 years and 9 months, it would have increased to $672. And that's a modest increase. With other ETFs, we may need to extrapolate this experiment for up to 20, 30, even 40 years before the numbers become something that many Americans could say would cover the majority of their bills. But with GPIC, that comes much sooner. So let's take its historical price return and dividend appreciation and extrapolate it out over the next 10 years. And I think you're going to be surprised. Assuming similar price appreciation and distribution growth, if we had reinvested all of our distributions in 10 short years, it would have grown to $1,071,913. Our monthly distribution would be $6,100, and we would have a whopping yearly distribution amount of $73,866 annually. I think if you're looking for a bridge between age 55 and Social Security, that's enough for many Americans. That's actually right in line with the average income of many families in America. And when you compare these results to traditional dividend funds, like say SCHD, it would take triple the time to produce similar results. Since GPIX is based on the NASDAQ, we certainly need to see a continued technology sector bull market for these returns to continue. And covered call funds do sometimes underperform in raging bull markets. In flat markets, slight downtrending markets, or slight uptrending markets, covered call funds can actually outperform. And the bonus that I think a lot of people are not paying close enough attention to, I get this concern a lot. People are worried about placing their covered call fund in a taxable account versus a tax advantaged account. People often aren't aware that GPIC has delivered over 90+% of its distributions as return of capital. A return of capital is not taxed in the year you receive it. It actually lowers your cost basis until your cost basis reaches zero. And what happens when your cost basis reaches zero? Actually, you're just taxed at long-term capital gains tax rates, which may be more beneficial than a normal distribution or a normal non-qualified dividend to a lot of investors. If your income's actually low enough and it's under the 0% tax bracket for long-term capital gains, you can actually reset your cost basis and do a lot of nifty accounting practices with your CPA to defer or even eliminate much of the tax that is due on these funds. And the United States is quite generous with its long-term capital gains rates. If you are actually a couple, it's almost at $100,000, and that's not even factoring in the standard deduction, which seems to increase by a healthy margin each year. So just some final thoughts. Most people spend their lives working for money. Very few spend that time actually building assets that work for them. Whether you choose GPIC, SCHD, VOO, or another investment vehicle entirely, the important lesson is the same. As soon as possible, start investing and stay consistent. Reinvest what you can and give compounding long enough to surprise you, because I guarantee there will be a point where you look at your portfolio and you are amazed at just how much of the heavy lifting it's doing. Eventually, one day, you're going to realize it's actually producing more than you can produce at your day job. And that's a pretty incredible feeling. So if you like this video, let me know in the comments. If someone handed you $50,000 today, would you invest it all at once? What would you invest it in? Would you dollar cost average into the market maybe? I'd love to hear your approach. Hit that subscribe button if you're not already subscribed, and I'll see you guys in the next one.